For years, New Jersey's housing market was untouchable. During the pandemic, prices surged as families fled New York City, desperate for space, for yards, for anything that wasn't a cramped apartment. Bidding wars became the norm. Buyers waived inspections. Cash offers over asking became standard practice. Every town within an hour of Manhattan felt the wave. The narrative was simple, stable, commuter-driven, supply constrained. This was a market that didn't collapse. It appreciated. It held. It rewarded patience and punished hesitation. But something changed in 2026. The surge stopped. The momentum reversed. And now, across 10 specific cities in New Jersey, the housing market isn't just cooling. It's beginning to fracture. The underscore quote, underscore zero, underscore signs are multiplying. The open houses are emptier. The listings are sitting longer. And the investors who bought aggressively during the boom are starting to panic. This is not a statewide crash, but it is a structural correction hitting specific markets with precision. And if you know where to look, the cracks are undeniable. Let me show you how we got here. Because understanding the collapse requires understanding the boom that preceded it. The pandemic migration surge was real. New York City became unlivable for a specific class of the professional, the ones with remote work flexibility, young children, and the financial capacity to leave. They flooded into New Jersey. They competed for limited housing stock. They pushed prices beyond historical norms in towns that had been stable for decades. The spillover demand from NYC created a buying frenzy that felt, at the time, like a permanent shift. Investors saw the surge and followed. Single-family rentals became an asset class. Small-time landlords and institutional players both piled in, buying properties they had no intention of occupying, betting that rent growth and appreciation would justify the leverage. And for 2 years, it worked. Prices climbed. Rents climbed. Everyone made money. But then the fundamentals caught up. Property taxes in New Jersey, already among the highest in the nation, continued rising. Homeowners' insurance premiums spiked, driven by climate risk and reinsurance costs. Mortgage rates, which had been historically low during the buying surge, doubled and then stayed elevated. The buyers who could afford to compete in 2021 could no longer afford to compete in 2024. And by 2026, demand had softened enough that inventory began to thaw. Sellers who had been waiting for the peak realized the peak had already passed. They listed, the market flooded, and prices began to adjust. The first wave of reductions was subtle. A few percentage points here, a strategic price cut there. But the psychological shift was unmistakable. The era of automatic appreciation was ending, and in 10 specific cities across New Jersey, that shift is now accelerating into something more severe. Now let's break down the 10 cities where the correction is hitting first. Number 10, Toms River. During the pandemic, Toms River became the embodiment of the suburban refuge narrative. Families wanted space. They wanted proximity to the shore. They wanted affordability relative to North Jersey. And Toms River delivered. The market exploded. Single-family homes that had been languishing for months suddenly had multiple offers. Investors moved in aggressively, converting owner-occupied homes into rental properties, betting on summer tourism and the long-term appeal of coastal living. But the math has shifted. Insurance premiums in coastal New Jersey have surged. Not just flood insurance, but homeowners insurance broadly, as carriers reassess climate risk and exposure to storm damage. What was once an affordable market became expensive to hold. Property taxes, already high, kept climbing, and the rental income that justified the investor purchases, it plateaued. The combination of rising costs and stagnant rental yields began to squeeze. Listings are sitting longer now. Days on market have doubled compared to 2 years ago. Sellers are cutting prices, sometimes aggressively, just to attract interest. The first wave of motivated sellers has begun. Investors who bought at the peak, leveraged heavily, and are now facing monthly losses they did not anticipate. The shore isn't immune anymore. The coastal premium that protected Tom's River during previous downturns is not protecting it now. The correction has arrived, and it is deepening. Number 9, Paterson. Paterson was the affordability alternative. When Newark and Jersey City became too expensive, buyers looked north. Paterson offered proximity to New York, transit access, and prices that were, comparatively, reasonable. Multifamily properties became particularly attractive. Investors purchased duplexes and triplexes, renovated them quickly, and either flipped them or rented them out. For a brief window, it worked. Rents rose. Buyers competed. The market felt hot, but the ceiling was reached faster than anyone expected. Rents in Paterson can only rise so high before they hit the income limits of the tenant base. When rents stalled, the investor model broke. The flipped duplexes that were listed for aggressive prices sat. Buyers, now regaining leverage, refused to overpay. Foreclosure filings in Paterson have begun rising. Slowly at first, but the trend is clear. Overleveraged investors who could not sustain negative cash flow are defaulting. Rental stagnation is becoming rental decline in certain segments, and the motivated selling that follows foreclosure is beginning to pull comparable sales downward. When affordability breaks, the floor disappears. Paterson was supposed to be insulated by its low prices, but low prices without income growth to support them don't hold. They fall. Number 8, Vineland. Vineland experienced the quiet South Jersey surge that many observers missed. It wasn't glamorous. It wasn't close to New York, but it was affordable, and during the pandemic, affordability became the dominant variable. Speculative new construction moved in. Builders assumed demand would continue. They put up developments. They marketed aggressively. And for a short period, they were right. Buyers came. Homes sold. But the buyer pool was smaller and shallower than the builders anticipated. Remote work, which had driven much of the initial demand, normalized. People who thought they could live anywhere realized they still needed proximity to something. Jobs, family, services, culture. Vineland, isolated in South Jersey, did not offer those things in abundance. The speculative developments that were supposed to sell quickly began sitting. Builders, facing carrying costs and construction's debt, started offering concessions, price cuts, rate buy-downs, upgrades included. The language of desperation began appearing in the marketing. And when builders compete on price, resale homes suffer. Why buy a 3-year-old house when the builder down the street is offering a brand new one at a discount? Demand moved on. Supply stayed. And now Vineland is absorbing the overhang of speculative construction that the market cannot support at the prices originally projected. Number 7, Jersey City. Jersey City was the crown jewel of the NYC spillover boom. Luxury towers went up at a pace that felt unsustainable even at the time. Developers bet that proximity to Manhattan, path train access, and the amenities of a built-out waterfront would justify premium pricing indefinitely. And for a while, they were right. Units sold, rents climbed, the skyline transformed But the luxury tower market is now oversupplied. The pipeline of construction that seemed brilliant in 2021 is now a liability in 2026. Too many units, not enough buyers at the price points developers need. Rental concessions are returning. First month free, 2 months free, broker fees waived. These are the tells. When landlords start giving away months of rent, it means the market price is lower than the lease price, and they are trying to hide the gap. Remote work normalized, and the commuter premium that justified Jersey City pricing softened. Why pay a premium to be near the PATH train if you only need to go into Manhattan twice a week? Investor panic is beginning in the luxury segment. The condo owners who bought pre-construction as investments are realizing that their units are not appreciating and in many cases are worth less than they paid. Glass towers reflecting uncertainty. The skyline that symbolized growth now symbolizes oversupply, and the correction is just beginning. Number 6, Elizabeth. Elizabeth rode the transit-adjacent boom. It wasn't glamorous, but it was functional, close to Newark Airport, close to transit, affordable relative to nearby markets. Investors loved it. They built townhome projects. They marketed to first-time buyers and renters priced out of Newark. And it worked until the fundamentals shifted. Commuter demand, which drove much of Elizabeth's appeal, softened as remote and hybrid work became permanent. The airport economy, which supports much of Elizabeth's employment base, faced its own volatility. And as demand softened, the townhome projects that were supposed to sell quickly began sitting. Price cuts accelerated. What had been a tight market became a buyer's market in under 18 months. Location isn't protection anymore. Elizabeth's proximity to transit and employment centers was supposed to insulate it from correction. But proximity without sustained demand does not hold prices. It just delays the decline. And now the decline is here. Number 5, Lakewood. Lakewood saw hyper-rapid residential expansion, unlike almost anywhere else in New Jersey. The population surged. New developments went up at a pace that seemed impossible to sustain. And for a period, it was sustained by a unique combination of demographics, financing, and optimism. But growth outpaced infrastructure, growth outpaced services, and growth outpaced affordability. The residential expansion that defined Lakewood's recent history created an inventory surge that the local buyer pool cannot absorb at the prices builders need. Inventory is rising sharply. Homes that were supposed to sell in weeks are sitting for months. Builders are competing on incentives, offering to buy down rates, offering closing cost assistance, offering anything to move units. The strain is visible. The optimism that fueled the expansion has been replaced by the pragmatic recognition that supply exceeded sustainable demand. Growth outpaced gravity, and now gravity is reasserting itself. Number 4, Camden. Camden was the revitalization optimism narrative. For years, the story was that Camden was turning around. Tax incentives brought corporate investment. Developers flipped row houses. The waterfront saw new construction. The narrative was compelling, and for a brief period, it attracted real capital. Investors bought properties, betting on continued momentum. Flipped row houses were listed at prices that assumed the revitalization would continue accelerating. But the momentum stalled. The incentive-driven investment that created the initial surge did not produce the self-sustaining economic growth that would justify the real estate prices. Flipped row houses are sitting. Rental demand plateaued. The capital that flowed in during the optimism phase is now retreating. Developers who planned follow-on projects are delaying them. The market is discovering that momentum without foundation is just speculation. And speculation, when it reverses, does not reverse gently. Camden's correction is not about a boom that went too far. It is about a boom that was never as real as the prices suggested. And now, the market is finding the level that the actual fundamentals support. Momentum without foundation. The phrase that defines Camden's current housing reality. Number 3, Newark. Newark was the downtown revival story. For years, the narrative was that Newark was finally becoming what it was always supposed to be. A real urban alternative to New York, with its own identity, its own economy, its own appeal. Luxury apartment towers went up. Corporate headquarters relocated. The Prudential Center anchored a district of development. Investors bought aggressively, betting on the continuation of the trend. But the revival met resistance. The corporate slowdown, driven by hybrid work, cost-cutting, and a broader reassessment of office space needs, meant that the job growth Newark was counting on did not materialize at the projected pace. The luxury apartment pipeline that seemed brilliant during the boom is now an oversupply problem. Vacancy rates are creeping upward. Developers are delaying projects, trying to avoid adding units to a market that is already softening. The office to residential conversion narrative that was supposed to absorb excess office space has not materialized at scale, and the residential demand that was supposed to fill the new apartments has softened. Revival meets resistance. Newark is not collapsing, but it is correcting. And the correction is forcing a reassessment of how much the market can actually support at the prices that were being projected. Number 2, Hoboken. Hoboken was untouchable. The ultra-tight condo market, the commuter premium, the desirability of the location, all of it suggested that Hoboken would never see a significant correction. And for years, that was true. Condos sold at premium prices. Inventory was limited. Competition was fierce. But even Hoboken is not immune to the structural forces reshaping the market. Investor-heavy condo ownership has created a particular vulnerability. Many units are owned by investors who bought pre-construction or during the boom, betting on appreciation and rental income. But rental income has not kept pace with HOA fees, property taxes, and mortgage costs. The carrying costs of owning a condo in Hoboken have risen faster than rents. And now, for the first time in years, price reductions are appearing in the luxury tier. Buyers are regaining leverage. Sellers who were holding out for peak prices are cutting. The correction is not dramatic yet, but it is real. Even the premium cracks. Hoboken's reputation as an untouchable market is being tested in ways it has not been tested in over a decade. And the test is revealing that no market, regardless of its desirability, is immune when the fundamentals shift. Number 1, Atlantic City. This is where the collapse is most visible, most severe, and most emotionally charged. Atlantic City experienced a speculative second home surge during the pandemic that defied all historical patterns. Remote workers who could live anywhere chose the shore. Investors bought condos, betting on short-term rental income from tourists. The short-term rental frenzy transformed entire buildings. Platforms like Airbnb made it seem easy. Buy a unit, furnish it, list it, and watch the cash flow. For a year, maybe 2, it worked. Occupancy was high. Rates were strong. Investors made money. But tourism is volatile. Demand fluctuates. And when demand softened even slightly, the entire model broke. Insurance costs in Atlantic City, already high due to coastal exposure, surged. Maintenance costs, especially in older buildings, climbed. And the rental income that was supposed to cover everything became inconsistent. Investors who leveraged heavily to buy multiple units found themselves underwater. Not metaphorically, but literally in terms of their balance sheets. Price collapses in specific segments have already begun. Condos that sold for premium prices in 2021 are now being listed for 30, 40% less, and they're still sitting. The psychological shift from speculation to exit is unmistakable. The sellers are no longer asking what the unit is worth. They're asking what they can get for it before the next mortgage payment is due. When optimism evaporates, numbers take over. And in Atlantic City, the numbers are brutal. This is not a correction. This is the collapse in slow motion. And it is the clear signal of what happens when speculative excess meets structural reversal. So what does this really mean? Not just for these 10 cities, but for New Jersey and for the broader housing market that many assumed would never correct again. This is not a crash everywhere. Many towns in New Jersey are stable. Some are still appreciating modestly. But what is happening in these 10 cities is not random. It is the result of structural forces that were ignored during the boom. Overbuilding relative to wage growth. Investor retreat when the return on investment math no longer works. Inventory normalization after years of artificial scarcity. And most importantly, buyers regaining power after years of having none. The era of automatic appreciation is over. The assumption that real estate only goes up, that simply owning property in a good location guarantees wealth, is being tested. And in these 10 cities, it is failing that test. This is not a crisis, but it is a correction. And corrections, when they are necessary, do not stop because people want them to stop. They stop when prices reach levels that fundamentals can support, and we are not there yet. Real estate moves in cycles. This is not a new revelation. What goes up comes down. What overheats corrects. What was scarce becomes abundant. What was competitive becomes negotiable. Markets cannot outrun fundamentals indefinitely. For a period, they can. Momentum, psychology, and liquidity can drive prices beyond what income, employment, and demographics justify. But eventually, the gap closes, sometimes gently, sometimes abruptly. New Jersey is experiencing that closure now, city by city, market by market. Some cities will stabilize quickly, others will shrink for years. The power dynamics are shifting. Sellers who had all the leverage now have very little. Buyers who had no leverage now have options. Investors who thought they were building wealth are discovering they were building risk. And the signs of this shift are everywhere, if you know where to look. The listings that sit, the price cuts that multiply, the concessions that appear, the financing that tightens, the optimism that fades. The signs are quiet, but they are everywhere, and they are telling the same story. The boom is over. The correction has begun. And in these 10 New Jersey cities, the collapse is no longer beginning. It is happening.